Thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of being self-employed, working for yourself, running a small business. So today I'm going to talk about how to account in your MTD software for making a provision for bad debts. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to find other information that we have on a whole host of different topics, all aimed at supporting you in your self-employment. And please do also look at our playlist for our bite-sized demo showing you how to use specific MTD software. So back then to making a provision for bad debts in your software and how you will do this. So you will remember from the information that we've talked about previously. So when we're making a provision for a bad debt, we're not actually ready to write the debt off. We still want to be chasing the customer or client for that. We're still going to be pursuing it. So we don't want to affect the customer's account, but we don't want that sale included in that financial period because we suspect there's a high chance that we won't receive payment for it. So in order to do this, we're going to be needing to raise a journal. And what we're going to be doing is we're going to be moving an amount from the sales in the profit and loss and creating a provision for bad debt in the balance sheet. So to do that, we will need to raise a journal, and we are going to debit the sales code that the original transaction was for. Remember, if you're VAT registered, to use the net amount. Otherwise the full amount, obviously, if you're not VAT registered. And then the credit would be to the bad debt on the balance sheet, the bad debt provision on the balance sheet. So that then will move the amount from your sales to your balance sheet, and so therefore it won't form part of your profit for the period in question. So then when you come into the next year, you may either reverse that journal at the start of the year, so therefore you would be moving the amount straight back to the sales and out of the balance sheet, or you may decide to wait until you know what's happening and keep that amount in that pot until it is resolved. So let's say, for example, that much as you weren't expecting it, you do receive payment from your customer in the next financial period. Then you would simply move the transaction back. So you would credit your sales and you would debit the provision on the balance sheet to move that back into the sales, and then that would go into the sales for that financial period. So that would be fine. So let's say, for example, that the customer hasn't paid, and you do decide through that second financial period that you are going to be writing off that debt, that you will no longer be chasing it, and you don't want to have that outstanding on your customer's account anymore. So in that scenario, you would again move the transaction back to the sales. So credit the sales, debit the balance sheet, and then you would actually write off the debt from your customer's account in the way that we've explained that in a different video. So hopefully this helps you to understand how to create a provision. We will look to add to the bite-sized series of the demos and actually demo how to actually do that in specific softwares. Thank you very much for watching. Goodbye.